6 undervalued dividend stocks near their 52-week lows. As always, we'll look at each company's historical performance. We'll take a look at their dividend safety. We'll dive into their financial metrics, seeing whether or not they are strong companies for the future. And as always, we'll run them through that valuation model, getting to our intrinsic value as well as our acceptable buy price, given that investor margin of safety, and look towards Wall Street to see their forecast for the next 12 months. So the first company we are looking at today is none other than Starbucks Corporation. Now they are down around 9% over the last 12 months, some of that to do with the ongoing boycotts. We can see right there at their 52-week lows. They do have a forward yield of 2.49%, and we can see their forward P around 22.5. Now, if you've been holding Starbucks over the last 10 years, bear in mind this does not include if you were to reinvest those dividends. You would be up 135%, and it has been a while, in fact, summer 2021, since we saw their all-time highs of around $126. Now, in terms of their dividend safety, it sits at 67. It does look to be safe. Market cap, $104 billion, a mega cap company. Now, in terms of recessionary metrics, well, last recession, they didn't pay a dividend, so we have no comparative data. Negative 6% sales, bear in mind that's above the S&P, which was negative 12. However, they did trail the S&P's return, negative 69% versus the S&P's negative 55. Dividend growth, pretty decent, 7.5% last September, double digits over the last 5 years, 17% over the last 10 years. Very, very strong for this very nice dividend growth company. And we can note they have increased those dividends for the last 13 years. In terms of dividend yield theory, well, we have a double sign of undervaluation with the current yield above the 5-year average of 2.01, as well as that forward P, 21.3, significantly below their 5-year average of 29. And we also note here the consumer discretionary sector P, however, is lower at 13.9. Now, in terms of the free cash flow payout, as always, earnings is susceptible to manipulation by management through accounting. I personally like a blanket rule below 60%. As always, if you want to be industry specific, for restaurants, you can bring it down to 50%. 2022, very high in my opinion at 90%. 2023, they did bring it substantially lower to 67%. 2024 expected to come even lower towards that 60% I like to see. So no real worries. I would like to see at a bare minimum a very high single dividend digit increase for Starbucks dividends. Free cash flow per share, well, it has gone from negative 37 cents in 2014 to 3.20 in 2023. So overall, it has moved in the right direction. Do bear in mind, though, pretty inconsistent year on year, as we can see. In fact, 2018, it went up to 7.20 before the subsequent 2 years falling down to 10 cents. 2024, though, it is expected to increase to 3.59 from 2023's $3.20. Sales growth, as always, at a bare minimum, steady moderate growth, 3 to 7%. We're seeing nearly double-digit increases every single year, which is very strong. COVID year, so justifiable, negative 11%, and 12% in 2023 does look positive. So we can see, numerically speaking, they have increased from 16 billion to 36 in 2023. They also return excess cash to investor pockets through those share buybacks, reducing those shares outstanding from 1.53 billion in 2014 to 1.15, essentially increasing that ownership that you have in the business. ROIC 10% or more. Again, if you want to be industry specific, above 12%. They've pretty much hit that every single year, excluding the COVID year. And in fact, from then it has been continually increasing. And on the trailing 12 months, 36%, very, very attractive for an investor, as this shows us that management are able to effectively allocate their capital. Operating margin, we do know it does straddle around that 60% that we want to see for this industry at a bare minimum. 15% in 2023, something to maybe keep an eye on, but over the last 10 years looking pretty consistent. Free cash flow margin pretty much every single year above that minimum 5%, 10% in the more recent period, so no worries with those margins. Net debt to EBITDA, the earnings before the interest, the tax, the depreciation and the amortization, below 3.5 for the restaurant industry. We can see that 2.06 in 2023, expected to go sub 2 in 2024, showing us that their balance sheet does look strong. And remember, this also correlates to that dividend safety. So no real worries there given the fact that this is well below 3.5 and their essential free cash flow payout does look to be trending down to around that 60%. So let's jump into the valuation for Starbucks. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, typically on the channel, we run through every single one of these models in our deep dives. Today's episode, let's jump straight into the intrinsic value, and we get to a value today for Starbucks Corporation of $116. Current price then at $90, we always use that margin of safety of 10% to start off with, ease us in, and then we use that if it meets three criteria: a wide moat, strong financial metrics, and good forward-looking data. And then we keep going till it's near the current trading price to understand what MOS level it is today. So we can see right now for Starbucks Corporation up to $92, we are getting a 20% margin of safety based on our estimates and judgments. And we can see Wall Street do have a forward-looking price over the next 12 months of $109, upside of 21%. Therefore, they see Starbucks as a strong buy now. And as always, do let us know your thoughts in the comments below as we do run through these companies. And also, just to let you know, we have released our latest free weekly article. If you want to gain access to this as well as all the other articles, all completely free, click on that pinned comment below, and once you sign up, you get instant access. The next company that we have towards their 52 weeks low, Bristol Myers Squibb company, ticker symbol BMY, down 21% over the last year. Over the last 10 years, pretty much up, well, flat, in fact, just up 1.94%. And we can see their all-time highs, in fact, not too long ago at $81. And we can see they do offer a yield currently of 4.6% and a forward PE sub 8 and a market cap of $106 billion. Now, in terms of their dividend safety, it does look to be safe with that 70 score, market cap $106 billion. They are a mega cap company. Now, in terms of those recessionary metrics, well, they maintained the dividend during the last recession. They didn't increase it, but again, they didn't cut it. Negative 20% below recession, remember, below the S&P, but they did beat the S&P on their return basis, negative 32%. Now, dividend growth, pretty decent for a company that does pay a very nice starting yield. 5.3% just the last few months, 7% over the last 5 years, and at a bare minimum over the last 20 years, they are increasing that dividend in line with inflation. Now, in terms of the growth streak, well, they have been increasing those dividends for the last 17 years, but they've also been paying dividends for the last 53 without a reduction. Now, in terms of looking at dividend yield theory, a massive undervaluation signal with that yield at 4.59 above the 3.15 rolling 5-year average. And we can see the forward PE 7.7 below that target, or in fact 5-year average of 9. So again, undervaluation. And we see the healthcare sector PE much higher at 17.4. In terms of the free cash flow payout, no worries whatsoever. Again, 50% for biotechs in general, below 40 in fact over the last 6 years, and we can in fact see 2024 expected to go lower at 33%, so no worries with regards to the payout. Very nice to see the free cash flow for more than not has been increasing year on year. 158 in 2014, 611 in 2023, expected to go substantially higher in 2024. So lots of positives with this company that does look to be severely undervalued. Now, we do know over the last 2 years they have struggled with that top line. In fact, 2022 was flat. If you include inflation, in fact, it would be decreasing. 2023, negative 2%, again, very poor. Prior to that, though, it has been very decent, and with these type of companies, it is always important to understand their pipeline. Total sales numerically then, in fact, nearly tripled from 16 billion in 2014 to 45 in the more recent period. Now, unfortunately, over the longer term, they would have diluted your position as they have been issuing shares, increasing those shares outstanding from 1.67 billion to 2.08. Now, in terms of the ROIC, we do note here that it hasn't been too bad, but it has been very inconsistent. In fact, the last few years at the very low 10 to 11%. Not the greatest, but to be honest, it really does depend on what you are targeting. Again, for biotech, if you do want to be specific at 25%. Otherwise, personally, I have a blanket 10% rule. It does come down to the individual investor themselves, their thesis, and their different risk profiles. Operating margin above 25% for biotechs, that does seem to be the industry norm. They have struggled with that, but it is important to note over the last few years they haven't been that far off it, so no real red flag indicator in my opinion, but something just to keep an eye on. Free cash flow margin, nice to note though, it has been increasing over the last 10 years. 28% in the more recent period, very, very strong. And in fact, they are a free cash flow machine and very high numbers over the more recent years. Net debt to EBITDA, so what we can see here is in fact in the more recent year, 1.63 above the 1.5. It isn't expected to move much in 2024 to 1.59, but again, just something to consider. It is around that maximum we like to see, although no real large impact to the dividend given that the free cash flow payout is looked to be under control. But again, just considerations, and you can factor these in when we do take a look at that margin of safety. So the intrinsic value in today's episode is the average of these four models, coming to $65.28. Don't forget, you can grab a copy of this model if you want to get to the intrinsic value, as well as the acceptable buy price of companies in your own portfolio, or those on your watch list by clicking on that pinned comment below. So a 10% margin of safety, a buy up to $59, 15% up to $55, 20% is pretty much 10 to 12 cents shy, so we believe a very nice 20% margin of safety for BMY in today's episode. In terms of Wall Street, well, they have a price target of $60, not as high as our intrinsic value. Nonetheless, they do see this as a buy now with upside of 15% over that 12-month period. The next stock that we are taking a look at is DEO. Now, this one has been down 13% over the last year. Over the last 10 years, however, you would be up 27%. We do note, however, the all-time high, $220, December 2021, nearly 3 years ago. Trading towards the lower end of the 52-week range, yield of 2.71%, a forward PE sub 19, and a market cap of $83 billion. Now, dividend safety, the highest score obtainable at 99, very safe, $83 billion market cap, as we mentioned earlier. And we can see in the last recession, they actually increased the dividend. They had plus recession sales, so well above the average growth. And they also marginally beat the S&P with that negative 51% return. Not a bad 5% increase. Again, you are essentially beating inflation if you're getting above 4%. In fact, 4% on average over the last 5 years, 6% over the last 20. In terms of their increase, well, they are a dividend aristocrat as they have been increasing those dividends for the last 25 years. In terms of dividend yield theory, well, we have that double sign of undervaluation, 2.75 above the 2.14. Likewise, forward PE below the 23 5-year average, and we can see it is also marginally lower than the 20.1 from the consumer staples sector PE. Free cash flow payout, now again, it is different, so now we see 70% for this industry, the consumer staples. Very high in my opinion in 2023 at 98%, surprising given their 99 dividend safety score, but it is nice to note that it is expected to reduce dramatically to 75% in 2024. Taking a look at the free cash flow payout, 48 cents in 2014, 81 in 2023. So it is increasing, but again, massive inconsistencies year on year. Again, positive to note that it is expecting a very large increase to their free cash flow from 81 cents to 136. In terms of the sales growth, well, in fact, the last 3 years have been very strong. Pretty strong, in fact, because it's above the 3 to 7% we're looking for as a minimum. But do note, prior to that, it wasn't that consistent, so something just to consider when looking at this company. In terms of the top line growth, well, in fact, nearly doubled from 10 billion in 2014 to 17.1, and the trailing 12 months showing that it is expected to continue to increase around that 22 billion mark. They have done some share buybacks, as you can see, very inconsistent, and in fact going from 2.52 billion to 2.25, so they have bought back in effect around 10% of those initial shares from 2014. ROIC, I like to see a good metric, and I like to see consistency, which is what they have delivered over the last 10 years, year on year, and 18% in 2023 is very attractive. Operating margin, again, as I just mentioned, consistency on a good metric is very, very strong for an investor. 30% pretty much nearly every single year over the last 10 years. Very healthy, especially when the minimum is 16% for the consumer staples industry. And the same can be said for that free cash flow margin, which is above 7% year on year. Net debt to EBITDA then below the 4 that we want to look at for consumer staples. 2.61, although we do see it is increasing to around 3.07, so something just to keep an eye on, but still lower than the 4. So again, no real red flag indicators with this company. In terms of their valuation, well, let's get to that figure, and it is the average of these three models today, coming at just under $170. So a 10% margin of safety, we see a buy up to 153, 15%, it isn't quite there yet, but not too far off it, so we see between 10 to 15% margin of safety for this company. In terms of Wall Street, well, their forecast over the next 12 months is $163, so they do see upside to this company of 10%. And as always, let us know your thoughts about these companies. The next one that we are taking a look at is Pfizer. Now, over the last year, down 30%, it still can't really catch a break. Over the last 10 years, down 8%, we see its all-time highs at just under $60. Again, trading right there at the 52-week lows with a yield just under 6% and a forward P under 13. Dividend safety, well, safe with a 75 score, 159 as we said earlier. Now, in terms of those key metrics, well, they actually cut the dividend during the last recession. They had above average growth and they marginally beat the S&P with their negative 45% return. Very poor increase if you ask me. Yes, you are getting a decent starting yield, nearly 6%, but you are getting increase year on year lower than inflation. Although over the last 5 years and the last 20 years, you are at least getting a minimum inflationary increase. They have also been increasing those dividends for the last 13 years. In terms of the dividend yield theory, well, a massive undervaluation signal on the yield, 6.01 versus the 3.94 5-year average. Although we do know the forward P is pretty much in line with the 5-year 12 as well. Healthcare sector P, however, is much higher at 17.4. In terms of the free cash flow payout, is something I have flagged before. This is essentially a very, very big red flag indicator. And one of the reasons why we do look at the free cash flow and not at the earnings, as you wouldn't be able to tell from here. What this signals, 2023, they paid out more in dividends than they generated in free cash flow. Now, I would say this is a red flag indicator into 2024 as it is still above 100%. Something to consider, especially when you factor in your margin of safety level in the valuation process. Free cash flow, well, 244, 85 cents, so it has in fact been decreasing over the last 10 years. However, they do now have a lot of cash after that COVID pandemic, which now they are looking to do a lot of acquisitions to really help grow their free cash flow and their top line. Free cash flow expected to nearly double into 2024. And we can see, in fact, prior to COVID, their top line was very, very poor, minimal growth. But since then, strong growth in the following 2 years, although we see an incredible negative 42% drop to their top line, making it go from around 50 billion in 2014 to 59 in 2023. They have done some share buybacks, as we can clearly see, 6.42, reducing it down to 5.71. Now, ROIC, not the greatest in 2023 at 3%. Prior to that, it hasn't been too bad. Something I would say to keep an eye on, as you really want to see a minimum of 10%. Although again, if you want to be industry specific, you can go around the 8 to 9% level. Operating margin, again, prior to 2023, it was looking very decent, 9%, and probably similar could be said on the free cash flow. Means something just to keep in mind moving forwards in terms of their pipelines and how they are expecting to start to increase not just their top line but also their other metrics like their margins, both operating and free cash flow. Net debt to EBITDA, again, a little bit strange that we do see that very well, in fact, that safe dividend score, given the fact that their free cash flow payout is above 100% and net debt to EBITDA is also around that 3 that we see as a maximum, 3.75, in fact, higher in 2023, although it is expected to be around that 2.97 in 2024. Again, something just to consider, especially when we now look at that margin of safety. So the intrinsic value for today's episode gets to a value of $31 and the price is around $27.94. Margin of safety then at 10%, a buy pretty much in fact at that level that it's currently at, just around 12 cents shy. So we would say if you were looking to buy this, it does have, based on the estimates and judgments today, a 10% margin of safety. In terms of Wall Street, well, they do see an upside. They essentially are saying you can get a very nice starting yield of around 6%, whilst expecting around 31.88 for the price target in the next 12 months, with upside of 14%. The next stock that we are taking a look at is Cisco Systems. Now, when we take a look at the historical performance, they are down around 0.26% over the last year. Over the last 10 years, they are up 126%. Again, doesn't include dividends reinvested, and we do see all-time highs at $63 nearly 3 years ago. They're also trading towards the lower end of the 52-week range, a forward yield of 3.2% and a forward P just over 13. Dividend safety, well look, it looks to be very safe. A score of 91, a market cap of 202 billion. They are a mega cap company. In terms of the recessionary metrics, well, no dividend was paid, so no comparative data. They had average growth and they did have a near S&P return on that negative 59%. Dividend growth, very poor again in my opinion, below that 4% we want to see. They came in at 2.6%. Over the last 5 years though, you would be in line with inflation. Last 10 years looking a lot better at that 10% year on year average. They have as well been increasing those dividends for the last 12 years. In terms of dividend yield theory then, we do see an undervaluation signal on the yield, 3.27 above the 3.05. On the forward P though, we see more reasonable valuation, 13.7 versus 13.9. And when we compare it to the information technology sector PE, it is much higher at 27. Free cash flow payout, nice to note, no real issues, pretty consistently below that 60% level year on year, 33 in 2023, 43 in 2024. No worries, no red flag indicators to note. Free cash flow per share, well, 211 in 2014, gone higher to 465 in 2023, so it has doubled. Although please note that in 2024 it is expected to drop down to 371, so it is pretty inconsistent, although moving in the right direction in the longer term. Top line, pretty inconsistent. Yes, 2023 was a very good year, double-digit growth to their top line. Prior to that, though, we do see some years of flat revenue, some years of single-digit negative, and some years of very small increases to note. So numerically, it hasn't really moved if you do factor in inflation at 47 billion in 2014 to 57 in 2023. On a more positive note, they have bought back a lot of shares outstanding, over 1 billion over the course of the last 10 years. So that is one way they have returned some cash to investor pockets. ROIC, nice to know, again, consistency and very strong metrics, 13%, and in fact, it has been increasing over the longer term, 29% in 2023, very nice for investors and even potential investors looking at these numbers. Operating margin or operating efficiency, they have increased the margins from 22% in 2014 to 27% over the last few years, and the free cash flow has been just very strong, very consistently every single year, so that is very positive for Cisco Systems. Net debt to EBITDA probably be my favorite metric from this company, 0 all across the board, meaning it wouldn't even take them 1 day to pay off all of their debt net of cash on hand, so no worries with their balance sheet or their dividend at all. So let's get into the valuation of this company. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button, as always, to notify when these videos are dropped. So 10% margin of safety, you buy up to $54, 15% up to $51 at 20%. Not too far off, but not quite there yet. So we would say a 15 to 20% MOS level for Cisco in today's episode. Wall Street, on the other hand, well, they have a price target of $57. They see upside of 16%, again, making this company a strong buy. The next company that we are taking a look at is Kimberly-Clark Corporation. Now, they are down 1% over the last year. Over the last 10 years, however, up 21%, and we can see their all-time highs around 4 years ago at $158, trading towards the lower end of the 52-week range, yield just under 4% and a forward P just over 18. Dividend safety, 88, very safe, 42 billion market cap, a large cap company. In terms of recessionary metrics, well, they increased the dividend, they had above average growth, and they also outperformed the S&P. In terms of dividend growth itself, well, 3.4% increase this year, so not the greatest, just a little bit off inflation. 3% over the last 5 years, again, mediocre. Over the last 20 years, not too bad at that 6%. In terms of dividend growth streaks, well, they are a dividend king. They have increased those dividends for 50 years or more, and they have been paying dividends for the last 89 years without a reduction. Dividend yield theory, so we can see here a double sign of undervaluation, 3.92 versus 3.39, and the forward P below that 5-year average, and in fact it is also below the consumer staples sector P of 20.1. Free cash flow payout below 70%, remember, for consumer staples, 57%, nice to note, in 2023, expected to increase in 2024, but around that maximum 70% we like to see, so not too bad at all. On the free cash flow, they have increased it, nearly doubled over the longer term. Two things to note: one, the inconsistencies, and the second thing, that it is expected to drop into 2024. Sales growth, again, mediocre, not really great, especially when we want to see steady moderate growth of 3 to 7%. Last year was very poor at 1%, although the last few years before that was okay, so do consider that with this company. In terms of total sales, we're looking pretty flat, 20 billion in 2014, 20 billion in 2023. Shares outstanding, they have returned some excess cash to investors. They have bought back some shares, as we can see here over the period, but don't expect a lot of consistency with this company in relation to those buybacks. ROIC, even though it has been decreasing over the longer term, 29% is still very strong in 2023, and overall their ROIC metrics year on year is looking very healthy. Operating margin, it straddles along that 16% year on year. The last 3 years they have had some trouble, but given it isn't too far off the 16%, there is no real worries there. Maybe something just to consider moving forwards. Free cash flow margin, what we can see here is it is above that 7% preference that we like to see every single year. 14%, very healthy in 2023. Finally, the net debt to EBITDA consistently below 4, 1.83 in 2023, 1.75 in 2024. No real worries with this company. It is one of those that is pretty consistent across the board. In terms of the valuation then, let's get to the intrinsic value. And as a reminder, you can grab a copy of this model if you want to get to the intrinsic value or the acceptable buy price of companies in your own portfolio or those on your watch list by clicking on that pinned comment below. So the margin of safety now, we're taking a look at a 10%. We get to that price of 127. 15%, it isn't quite there yet, not too far off. But for today's episode of Kimberly-Clark, we see a 10 to 15% MOS level. In terms of Wall Street and their forecast, well, they have a price target of $137. They see an upside of 10% for this company. That is pretty consistent. You do know what you're going to get with this over the longer term. As always, though, do let me know your thoughts in the comments below. Are you adding to any of these 6 undervalued dividend stocks? Maybe they're on your watch list, you're waiting for a certain price, or maybe for whatever reason you are quite bearish on these stocks and you aren't looking to invest. As always, have a great day. If you enjoyed the episode, double smash that like button, hit that subscribe button, and as always, I'll see you on the next one.